Welcome to the Gray Report. I'm your host, Spencer Gray, and every single week on the Gray Report, we're breaking down the latest research, reports, news, articles, and data, all surrounding multifamily investing or the multifamily industry. We're also covering, other things in commercial real estate, in the macro economy, but kind of all through the lens of multifamily. My name's Spencer Gray, and I'm the president of Gray Capital. We're a multifamily investment firm, fully vertically integrated, based out of Indianapolis, Indiana. And again, we started this because we're trying to figure out what is the information that my company needs and our investors to make some really informed decisions. We started doing this to say, let's share all that data, let's share all those resources within broader investment community, and now just the broader community. So we're happy you're here in the right spot. Co-host Griffin Haddad is joining me once again today because we have a great episode. First off, we have another edition of the Jargon Bin, which we're breaking down kind of industry terms to three different levels, everything from very much beginner to kind of intermediate to really advanced. And so today we're going to be talking about internal rate of return, or IRR, versus equity multiple. But then after that, we've got some interesting articles and data points. Yardi Matrix has updated their forecast for 2026, specifically related to supply. Supply has been driving the whole narrative and the story. It's why rents have been slowing down. It's why we're seeing absorption spike. Now it's receding. Following the Yardi report, we've got a piece from RealPage, and that more squarely focuses on that demand. We had negative net absorption back in the fourth quarter. If you're an operator, that sounds about right. We want to dig into some of those details. And then lastly, we want to get into the new nominee for the Federal Reserve Chairman, Kevin Warsh. Now, again, this is the guy who's going to be sitting on the committee, running the committee that's essentially, for the lack of more sophisticated terms, setting the price of money. And all of this trickles down to the trajectory of the U.S. dollar, the U.S. economy, the global economy. And again, we're setting the price of money. What are those discount rates? What are the long-term and the short-term notes? What are those yields going to look like? And how it relates to cap rates in the multifamily industry. It can seem like it's further removed, but nothing could be further from the truth. What happens at the Fed directly relates what happens to multifamily pricing and the direction of that pricing. We're going to get into all of it and more. Make sure you're subscribed to the Gray Capital YouTube channel if you are not already. We got a newsletter on the Gray Capital website, graycapitalllc.com. Great episode, Griffin. Let's get into it. All right, welcome back to the report. Joined again by Griffin Haddad. My gosh, Griffin, it's getting hot in here. I don't know if it's because of the reports, these articles, the lights. I had to take my jacket off between the intro. How you doing this week?
Awesome. If this episode is anything like that intro, our viewers and our listeners are in for an all-timer.
Oh, good. I'm gonna interpret that in a positive way.
An all-time episode coming up.
Yep. Well, okay. In order to do that, we got to jump right into it, because one of the challenges is that everyone tells me I'm long-winded, or at least I am acknowledging that myself without anybody having to tell it to my face. So jumping right into the Jargon Bin, and again, it's a new series that we're doing, a part of the Gray Report, where we're breaking down these terms, industry terms that get thrown around. We use them interchangeably all the time, just in passing. We just describe other things, all these, pick your term, DSCR, NOI, cash on cash, the list goes on. So we're trying to break these down every single week to help everyone have a better understanding. Again, whether you've never heard these terms before, or you want to have a little bit more of a nuanced understanding, or understand how we see these terms, that's what we're here to do.
This is a great week for the Jargon Bin. We focused on terminology, but we're actually going to compare two terms in this week's episode of the Jargon Bin, comparing the internal rate of return, or the IRR, along with the equity multiple. And so those are two kind of return metrics in regards to investments, specifically in multifamily. When we bring a product out, we are advertising or marketing to our investors or our equity partners what the deal would look like on the surface relative to the overall returns or projected returns that an investment may have. Routinely, we get asked all the time, hey, what's the IRR? or hey, what's the equity multiple? It's really just kind of a quick screen as to the overall financial health or the opportunity to generate a return for our investors. Here internally, we prioritize equity multiple, but there are investors that otherwise are prioritizing IRR. And so I'm excited to kind of jump in, compare the two. So let's go ahead, let's get started just on the base layer of understanding an equity multiple. How would you define that to somebody that's hearing that term for the first time?
Yeah. Let's start with the equity multiple. Because again, these two terms I think are probably the most misunderstood and can kind of get swapped. So very simply, equity multiple, very simply, is how many times did I get my money back? If I invest $1 and it turns into $2, I have a 2x equity multiple. Times that 1 times the multiple of 2 equals 2. So expanding that out, adding a couple zeros, your $100,000 turns into $200,000. That's a 2x multiple. And that includes, specifically with a private equity investment like multifamily, that includes all of the cash flow. So it's not just your proceeds from a sale, it's all adding up all of the distributions that you've received over the lifehood of that investment, adding it all up. And so you basically take all the money that you received divided by the money that you've got or that you put into the deal.
So it seems like a relatively simple math equation of the initial investment amount at the very end term, when that investment closes, how much money you end up with in bulk. What multiple would you have to apply to that original investment amount to then get to that end number of dollars that you received?
If I put 1, I get 2, it's a 2. If I put 1 and I get 3 out of it, it's a 3. Simple as that.
Very simple. The internal rate of return, or IRR, is just another return metric that we use to quantify the returns generated through an investment, specifically in multifamily real estate. At the basic level of understanding of the IRR, or internal rate of return, what does that mean to you, and how might it differentiate from the equity multiple?
So this is where people get caught up, and it can be confusing. If you want to look at the formula for IRR, I mean, it's just this long formula. The easiest way to explain it, it's more of a time-based metric, and it's how fast did my money grow while it was invested. Not just what I got back, but when. That makes sense.
Yeah, so let's just say the investment it's a 10-year time frame over the investment. There could be moments in that 10 years where you have increased cash flow, or there's an opportunity for you to receive more funds, and then in the later half, maybe it slows down. So it's kind of taken into the account in this equation that if you look up, it is taken into account how fast you're receiving or how slow you're receiving your returns.
Exactly. So like an early refinance in a project or a bulk of cash flow distributed early will impact your IRR and produce a higher IRR. Whereas an equity multiple, the timing of the cash flows don't matter. You're just summing up all the cash flow that you've received. And so IRR can tell you of different attributes and get into more nuanced return profile than equity multiple. At the same time, IRR is more easily manipulated because of all those time-based inputs. So that's why some investors love IRR, some people hate it, and that's why some investors really like equity multiple, because it takes all the timing out of it.
Right. I can feel us wading into some deeper waters here and staying in the shallow end just briefly. Equity multiple is how much money you've made versus the internal rate of return is how fast that you made it.
Exactly. 100%.
Let's continue, wading a little bit into the deeper waters in regards to the equity multiple versus IRR. You mentioned that the time weighted nature of IRR. Can you walk me through, and you said it's more easily manipulable or manipulated. What about IRR would maybe attract an investor in regards to an overall investment that maybe equity multiple wouldn't?
Yeah, so getting a higher IRR is going to typically be related to a shorter term investment. So if you're looking to really recycle that money in a shorter period of time, and that you don't really, you're not as concerned about your true total return, but like what's the most efficient use of my invested dollars, you might look at IRR. So a lot of like value add investors who are looking for maybe a shorter investment horizon might focus on IRR to achieve a 20% IRR, for example. A 15% IRR is the typical target of kind of private equity investing, whether it's real estate or whether it's preferred equity. But if you wanted to have like a shorter time period and get to a 20 IRR, 30 IRR, those are the types of deals where you might look at a 1 to 2 year hold period to achieve. Achieving anything above that over a shorter period of a longer period of time is very difficult to do. And so if you're a longer term hold investor, you have a long time horizon, you might not be looking for a higher IRR, something that's more in the middle. But really, if you have a longer time horizon, your focus might be more on the equity multiple rather than the IRR. You're looking for your total dollars. I want to take that $100,000, turn it into two. I'm less concerned about like when that happens. You might say I want it to happen within a 5 or 10 year period, but I don't need it to happen tomorrow. IRR is if you're a really more sophisticated investor and I'm stacking different investments and some are going to be short term. I'm focused on the velocity of money. I might then focus more on that IRR metric rather than equity multiple.
So a 2x equity multiple could be over the span of 2 years, but it also could be over the span of 10 years.
Exactly.
And that time that elapses, there's obviously then 2 years. So if you double your money in 2 years, the IRR is higher.
Yeah.
So you'd expect a greater percentage IRR as opposed to the 2x equity multiple over 10 years, which it took a longer period of time to double your money. So in that 10-year example, the IRR would be lower than the 2-year example.
Exactly. IRR rewards shorter term holds and really disencourages longer term holds. And so again, you have that 2x equity multiple over a 10-year period. Again, the 2x might seem attractive, but the equity or the internal rate of return on that same investment might be 11%, 12%, might not look as attractive, but that same investment, it was a 5-year hold period, that IRR, even though the equity multiple would be less, you might be looking at closer to a 15% IRR.
Interesting. I'm starting to see the value of not just taking these independently of each other to evaluate a deal, but also using them together as a tool.
Yeah.
If I saw a deal that came across my desk that was marketed as a 5x equity multiple, well, that sounds awesome. But got to look at the investment period or the hold period. How many years or what amount of time needs to lapse or pass for me to receive that 5x equity multiple? It might be 25 years. Versus a deal that comes across my desk that's a 2x equity multiple, but the hold period is only a 5-year term.
Exactly.
One of those is going to be for me. One of them might not be for me. But the time component of IRR really is largely important to understand. But then pairing both equity multiple and IRR to make certain that investment matches my, as an investor, overall lens for that or threshold or capacity to withstand that investment horizon, the hold period, and then it shares an alignment of interest with what I'm looking to earn in overall returns and how long it takes.
Yeah, I think the key is exactly what you said, Griffin, is never using just one of these metrics, but using a combination of whether it's IRR, equity multiple, and the third return metric that we really focus on, which is cash on cash return, which we can talk about at a later date.
Right. That'll be a late addition to the jargon bin potentially for next week. We're getting into deeper waters. Let's dive into the industry and veteran kind of realm of IRR. It's extremely sensitive, obviously, to the time that we're discussing. And so what aspects of the timing of a project would influence the overall IRR for that investment? You mentioned refinance earlier. What else would be kind of encased into altering the timing of returns in an investment?
Any kind of early return of capital will significantly influence that IRR, positively. So again, whether it's a refinance, it's an early return of capital, and maybe it's not even necessarily an early refinance, but any sort of return of capital within the hold period can have the effect of increasing the IRR. And so what investors need to just be mindful of when looking at those capital events, which can boost an IRR, how likely are those capital events to take place? So for example, let's say you have a 10-year hold period, but you've baked in a refinance in year 2, year 3, year 4, or maybe even year 5, at some point in the middle of the hold period. Well, that could be true, and that could be part of the business plan, and it could be appropriate. But you should look at it through the lens of, well, what if that doesn't happen? And if you remove that refinance, if you remove that capital event, you're going to see a significant reduction in that IRR or internal rate of return. So again, it can be used appropriately, baking in that refinance if that is, again, a core part of the business plan. For example, you're going in, you execute a value add, but it's not a short-term hold. you're looking to flip out on maybe a short-term bridge loan to a long-term, permanent loan, and there would often be a return of capital at that point in time. But again, that's all if everything goes well. If things don't go the way that they were planned and a refinance doesn't occur, or a refinance without a return of capital, that can significantly change the terminal return metric in the IRR. And so you just want to go and you just have to be nuanced and really understand what are all the levers that can influence IRR. And, an exit cap rate is another one, but that also can influence equity multiple as well.
Right. There's a lot of speculative nature to our industry and our investment strategies in general. We're looking 5 to 10 years, forward and trying to project, what revenue and expenses. And you talked about exit caps and potential refinances in the middle of a hold period. Is it? I don't want to say appropriate because I think it's not appropriate, but how often will investors or operators go through their underwriting model and try to solve for IRR in order to kind of financially engineer a deal that looks on the surface to be a little bit more palatable? And if so, if that's relatively high occurrence, what should investors be looking for in that regard? You're talking about refinances that otherwise wouldn't happen. Maybe it's a cash in refinance.
I just want to throw something else out. And all that is true, is worth noting. But where I see investors, I guess, making the mistake, and it can be solving for IRR, because it's like, well, what is your true goal? Is it income? Is it appreciation? Maybe equity multiple is more important. But the mistake I see more investors make is when they are using IRR as a comparison tool. And IRR is really developed to compare investments, just to figure out what their IRRs that are time-based. But when it's inappropriate is when you're comparing two different investments with two different time horizons.
Right.
So a 3-year hold, a 5-year hold versus a 10-year hold. You shouldn't compare the IRR of a 3-year hold and a 10-year hold. Clearly, the shorter term 3-year hold is going to have a significantly higher IRR. It might show a mid-20s IRR. It could be it could look like a home run, whereas the same deal, but it could be a 10-year hold, might show a 14, 15, or 16% IRR. And one might think that, well, the higher is always better. Higher rate of return in all cases often also means more risk. And so, it's hard to compare too. And sometimes that'll happen, if we have a project and we're walking through the deal with a prospective investor, and they may say, well, I'm looking at this other deal. Why is your IRR lower than this other deal I'm looking at? This one shows a 23% IRR. All the deals I've done have been mid-20s IRRs, but you're showing me a 16. Why in the world would I do this low return deal?
Right.
And we have to explain, well, you were investing in short-term flips, 2 to 3 year holds. You're looking at a 7-year hold. It's really a different strategy, and it might be for a different goal. That's when you have to kind of dig into the details with investors, determine what are your goals. Are you looking for a high velocity of money, potentially higher risk? You want to go in, flip something, generate maybe a big IRR, maybe not a big equity multiple, but you're going to continue just to turn those deals, deal after deal after deal. That's a higher risk strategy. You can make a lot of money doing that, but it's higher risk. Or do you want to? I see as a more balanced approach, still being able to get a good IRR, a healthier equity multiple, but taking a little bit lower risk. I think that's achieved by a longer hold period, at least 5 years. And so that's where I'm really looking more at what my equity multiple is. I want to at least double my money over a 5-year period, and I want to triple my money over a 10-year period. Those are my kind of general rules. What the IRR is, I personally, I want to know, but I don't care nearly as much about how many times I'm multiplying my money. And I bring the time factor just into it by referencing a 2x over 5 years, a 3x over 10 years. Again, it's a simpler way to look at it, but there's just a lot less jockeying with, when a refinance occurs and there's a return of capital and, comparing a 34 IRR to a, 20 IRR, what's the difference?
Right. There's many more variables need to be considered when referring to IRR, especially when you're looking at a deal. We have investors here at Great Capital that will compare our past offerings and past investment opportunities and want to know, why this current offering is a, lower IRR compared to the last one. Why would you bring out another deal that was inferior to to the previous one. And very often we have to, describe, well, the last one was a 10-year hold period. This one's a 7-year hold period or 5-year hold period, just based on the term for the debt. So just to kind of bring it all the way back around and kind of wrap it back into the most simplest terms, IRR is a speed metric of wealth creation and wealth generation, overall returns, while equity multiple is simply a wealth metric.
Yeah.
Any other take-home messages for the viewers?
No, I don't think so. Well, I guess one is we didn't talk about, for good reason, which is AAR, average annual return. And I'm not going to say it's a bad metric, but it's not our preferred metric. And just be careful that you don't confuse IRR with AAR, because there are some sponsors that will use AAR purposely to conflate with IRR, because your AAR, your average annual return, I don't even get into the formula for it.
Yeah.
It's simple, but it's there. Operators, sponsors will use it when their IRR they think is too low to advertise to investors, and their ARR makes the deal look better than it really is.
Right.
And so you can have an AAR with 20, but the IRR might be a 14 or 13, and no one wants to come out with a 13 or 14 IRR deal because they think that it'll look like too low of a return. So they'll use some. It's not a made up metric, but I think that at times it can be misleading at times because it's used because investors are thinking about IRR. That's my only other takeaway. And we can talk about cash on cash another time. It's a little more straightforward, but
Yes,
it's important
right.
to talk about.
I think that the last thing that maybe I want to throw in here is we've talked to,
So you're the one.
I know I'm
You're
the one that's causing problems, but I just have one last question for you. There are investors that want to see the bulk of an overall return come from cash flow.
Yeah.
And a significant percentage of that IRR coming from cash flow rather than maybe the speculative nature of cap rate compression on the back end, or overall NOI growth on the back end. Can you maybe briefly mention how IRR can become maybe misleading to those folks that are looking at cash flow, just based off of the growth potential at the exit? And so I guess what I'm trying to get at is there are investors that are looking to retire, that are looking for that monthly cash flow, versus the investors that will invest in a project that has a high IRR because of growth, but maybe doesn't see as much cash flow on the end. How do those two investment strategies or potential models, how do they differ? And, I guess we're more prone to cash flow here at Gray Capital. So talk a little bit about how the cash flow can impact overall IRR.
Well, the higher cash flow earlier on certainly will increase your IRR. And I think really what you're getting at is, what component is coming from, cash flow from operations, and which component is coming from capital appreciation.
Right.
We bought the property for $10 million. Now it's worth $20 million. And so how much of return is generated from, just from selling the property? And the reason why investors ask that is because it removes some speculation. It's saying it's not how much can you sell it for, because you're speculating not just on what cap rates are going to be in 5 or 10 years, but also where you've been able to grow rents to be able to divide by a cap rate to come up with your eventual value of the underlying asset itself. And so let's remove some of that speculation, because you and I don't know what we're going to sell it for, but how much cash is it going to deliver? Now, it can be difficult, depending on your hold period, to have 50% of the cash flow coming from cash flow operations. For a 10-year hold, you'd essentially have to at least be cash flowing. Just 5% for 10 years will do it. Or if it's a 5-year hold, you have to be at 10% for 5 years. And typically, the deals it's very rare to see that level of cash flow. Now, I would also say that cash flow, there's speculation in the cash on cash projections as well.
Sure.
Because, assuming you're not buying with an in-place, yield on cost going in at an 8, 9, 10% cash on cash return, often you're going in with a lower cash on cash return. You're executing a business plan, you're fixing up the units, you're operating the property better, and so you grow from, call it 5 or 6% cash on cash in the first year. You're growing it to 8%, 9%, maybe even 10% over time.
Right.
And so there's a ramp up. But that ramp up involves speculation. It assumes that you've successfully executed the business plan. You've been able not just to renovate the units and not go over budget, but you've been able to release the units at your target rents. All of that, you can have a perfect execution on the rehab, come in under budget. But if you thought you were going to get $250 a month in rent premium and you only achieve 100 or 150, well, that ramp up from 5% cash on cash to 8% cash on cash may never happen or may not happen at the same rate over the same time period that you originally projected. So I go and say all that. It's a good question to try to bifurcate cash flow and appreciation. It's also important to note that, most business plans are speculative, and if you strip out, if you only look at a pro forma or a business plan and said, I don't want you to incorporate any cash, and this is it's untrended yield on cost, which it's a term that I do really like, because it's like, what are we actually buying here? Mm-hmm. If we bought it and we didn't do anything to it, we didn't grow rents, we bought it and let it go. What would it? We didn't even we didn't allow ourselves to grow rents. What would the return be? And obviously, if expenses grow and revenue grows, the return goes down over time. So it never looks good, but it shows you what your baseline is. And so the business plan is basically saying, we're going to take this untrended yield on cost, but we're actually going to do something. We are going to try to raise rents through just organically moving rents to market, mark to market, or we're going to add value, increase the underlying and the perceived value of the property to achieve higher rents. Well, again, just nothing in life is guaranteed, and then it comes down to the strength of the business plan, the market knowledge. If you're already at the top of the market and you say you're going to raise rents another $100, maybe that's possible, but there might not be a data point other than maybe an income demographic to point to. If you're buying a property that is $200 below the rent of the property across the street, and it's the same style, same finishes, well, that's a pretty strong data point. I think you could probably at least raise the rents $100 and still undercut the guy across the street. So every business plan is nuanced. And the question about cash flow and appreciation is a good question, but it doesn't always it doesn't necessarily solve all questions, and it doesn't necessarily flush out what people want to flesh out. What it does tell you is just how much speculation is going on from the back end versus the front end.
Right. Understood. I think I asked that question primarily just to kind of pick your brain, but I think there's folks that ask us that question that are trying to maybe weed out or make certain that there is no refinance baked in, or that we don't have a speculative capital event in year 3 and year 7. And also, we do have existing investor base that does prioritize cash flow, and I think they just want to see that each deal that we're bringing to them does have robust cash flow to kind of pump the returns.
One of the reasons why multifamily is such a favored investment, and the reason why I love it, is that it's really well balanced. Some investments are all about cash flow. Some are all about growth. Some are just about diversification. Multifamily finds itself in a sweet spot of being able to provide really stable cash flow that's durable. It's also very tax efficient. But also there's a great opportunity to have capital appreciation and achieve a strong equity multiple. Now, I think it's smart when approaching, at least the way I see of buying apartments, investing in like existing assets, is you buy for cash flow. Especially you're looking at what they've been able to achieve, and what you essentially your untrended yield on cost. Like, what are you going to get just right out of the gate, and then how can we make this better? How can we add to that cash flow? And look at your exit, look at the equity multiple, look at the IRR. But there's a saying, you can't eat IRR, and I can have a very strong feeling of where interest rates may be in 5 years, 10 years, and related to that, cap rates. But you need to raise your hand and say we can't predict the future at some point, and that involves a higher degree of speculation versus my viewpoint on this particular asset, this particular market, at this particular point in time. Can we execute a business plan to achieve higher rents within 1 to 2 years? I'm more confident on that pro forma, and because the downside is maybe it took 3 years instead of 2, not oh, well, we thought cap rates would be 4.5 in 5 years, but in fact they are 6%. Because then the deal just doesn't work. But if I'm focusing on the cash flow itself, well, I can continue to cash flow a deal. I can cover my debt service. Typically, if there's healthy cash flow, that means I'll have opportunities to refinance, and I can control my exit point, especially if I have long-term permanent fixed rate financing in place.
Right. Makes a lot of sense. And that's why we see the deals that we do see coming through the Gray Capital investor portal is usually fairly robust cash flow in year one from day one of operations.
Yeah. And it's not as much, times have changed. And we were in a period when I got started that you could achieve 7, 8, 9, 10, 11% cash on cash year one out of the gate. Mm-hmm. Often there's interest only involved. Sometimes there was maybe a bridge loan to a permanent HUD loan because interest rates weren't flowing around. But that's because cap rates were more in had like a 6 handle on them. So you could get some real leverage, you could get some positive cash flow. As investors piled in, cap rates compressed, and eventually interest rates rose. You eventually saw those cash on cash margin decrease slowly over time. It's a little bit of boiling frogs, but instead of coming out of the gate with 8%, now it's typically starting kind of at 5%, growing to 8% over time. Mm-hmm. And that's a reflection on a number of things. I mean, again, it's interest rates. Interest rates are lower. Cap rates are lower. And the reason for all of this is because there's just been an increased investor demand in multifamily. Mm-hmm. Office, we used to be the poster child of commercial real estate. If you invested in commercial real estate, it was office, maybe a little bit of retail, maybe a little bit of industrial, maybe a little bit of multifamily. Now it's multifamily, it's industrial, and then a little bit of retail, and then office is this ugly-haired stepchild on the back that everyone's trying to figure out what to do with her. Was that an inappropriate description of the?
I think so. I think that's just fine. Boiled frogs. I think we should use the boiled frogs and jump into our first article, the Yardi Matrix. Kind of reframed their supply expectation for the years of 2026, 2027, and 2028, talking about being speculative. But the storyline really across 25 was that we're going to hit this supply cliff. I mean, a very sharp, steep drop-off in deliveries of multifamily assets really in the back half of 25 and all the way across 2026. Yardi Matrix released a updated report to their supply forecast last week on January 5th that increased their overall forecast for completions in 26 by 6.4%. And in 27, it jumped by 8.1%. And then all the way in 2028, it rose 8.9%. I don't think those are small numbers relative to the overall general supply across the United States. But I do think it is interesting that the story for really the last 12 months has been this big, sharp, steep, observable, palpable drop-off in overall deliveries in the multifamily asset class. But here we are at the start of 26, and we're saying, wait, we were wrong. We're off by 6.4%. There's actually increasing supply, relative to that initial idea of this cliff. I think it's just kind of we're watching supply. You and I have talked about it on here for, months on end about how the supply cliff it's more of a metaphor, and it's not, really as steep of a cliff as we think it is. It's definitely a curtailing and a pullback. But it was interesting to see that Yardi Matrix went back and revised their overall forecast by 6.4% in overall completions for this year.
Yeah, there are a lot of investors, a lot of developers and owners that have been, talking about, like you said, this supply falling off a cliff, and that's not happening. We should probably remove that language from, we don't say it, but other folks.
Right.
Supply is not falling off a cliff. Now it is declining materially, to pre-pandemic levels. That is 100% true. There has been a big slowdown in construction activity. And deliveries are slowing down to a much, a healthier pace. But there's not going to be that reversion to the mean of where we would have below trend growth or below pre-pandemic deliveries for a period of time. Mm-hmm. That would kind of get us back to a net normal over a multiple period of years. And that's good probably for the America's housing market. It's good for renters that there's going to be the supply and rents are going to absolutely spike up, which while investors, we might like that spike, it actually can create just volatility in the market. And again, I'll take rent growth where we can get it, but I think just more sustained positive rent growth is healthier for just probably the overall industry, probably. The other just comment on this report is that, and I don't think they necessarily go into it in detail in the report. Griffin, correct me if I'm wrong, but it's the geographic, the divergence of some of the supply, the where the supply is coming online is still where it has come online, where there's a really a glut and an oversupply. Mm-hmm. That is still where the new supply is coming online.
Correct.
So it's not as though everyone built apartments in Austin over the last several years and it's oversupplied, and now we're building apartments in Indianapolis or Columbus, Ohio, or St. Louis or wherever.
Right. They've just
we have oversupplied in Austin, and now we're going to continue to build apartments in Austin.
Yes.
And markets like Indianapolis, Kansas City, others are getting they had above trend supply, but not insane amounts. Definitely multi-decade peaks of new supply, but absorbable supply.
Right.
Many of those markets are going now to sub pre-pandemic pipelines, and will probably recover to kind of just a normal to a normalized level. But it's many of these markets that, again, are just already oversupplied are going to see just a continued level of supply. So it's it's not survive until 2025. It's continue to, I don't know, get a robust vessel for the next decade, and strap in for a true operating period, but also not a period of I think opportunity. But it's the show. It's the challenges have changed, where previously it was interest rate challenges, debt service was increasing, all these people were on floating rate loans, and so they're good demand, rent growth was good, but your debt service doubled what you thought it was. That story is less and less. Any new deals have rates baked in, and people have either recapitalized, refinance for the most part, and there's capital out there, so that's why we haven't seen all the distress related to loan maturities. But now the challenge is growing the rent roll, growing revenue. In many of these markets, they've been negative for going on 2 or 3 years, and it doesn't appear there is much reprieve. So we're going to see a dynamic where there will be continued rental declines in markets like Austin and Denver, and some softness everywhere else. But the everywhere else will recover a little bit quicker because we just don't have the onslaught of supply, and many of those markets didn't see really any negative rent growth. Maybe it was flat, but will pick up a little bit quicker. And so when you look at the compounding of rent growth over a period of time, you're going to see some big wins in some markets that are a little underappreciated, or they have been historically.
Right, not those mainstay headline markets that we're seeing that are drastically oversupplied.
Yeah, and that are all flashing green in terms of demographic. Like, again, Austin, there's a reason why people are building apartments in Austin. It's because people are moving to Austin. The reason why people are moving to Austin is because the jobs are moving to Austin. There's quality of life, it's politics, it's all of these reasons. But so many investors were like, hey, everyone's moving to Austin, let's all build in Austin. And again, if making up numbers, if 1 million people move to Austin, that's great. I might want to build apartments, but if we build 2 million apartments, well, maybe we've built too many apartments. So again, it's a great case study for capitalism and little freer markets of kind of bringing prices down. And I know it's being touted, politically for those reasons of look, here's a market that's a let people build. Rents are actually declining because the solution is supply. It's not, new restrictions or, even incentives. It's just literally let them build because there's demand, and that's going to bring down those prices. So it's fascinating to watch.
It is fascinating. We've talked about supply. Would love to jump over to the RealPage Analytics produced a article that says big markets are still seeing apartment demand in the fourth quarter. There is a great visualization, and the reason that this caught my eye, Spencer, is there's a graph on here that is showing that the U.S. apartment market actually experienced a seasonal net move outs in Q4 of 25 for the first time in what would be 3 years. So as we're seeing more and more supply being brought to the market across 25, we're kind of seeing it pull back in early 26. Yardi Matrix just increased the percentage of new deliveries in 26, but RealPage is reporting that across Q4 was the first quarter in 3 years that the apartment market in the United States actually saw net move outs. We're just curious, with this information and this data, our portfolio, what we've seen in regards to, supply challenges with demand and overall leasing and occupancies.
Yeah, I think this was highly anticipated. As the new delivery and supply was coming down, we were also going to see absorption come down, because as supply was delivered, we saw absorption come up, which was a real positive fundamental story. Is that at least there is interest and demand for all these units. The units are getting filled. It's just they're being filled at a lower price point than developers want. Because again, all we know how to build is luxury. It's not all we know how to build, but it's all we can afford to build. It's the only thing that makes sense, because those rent levels are what makes the deal pencil.
Work, yeah.
But then when we deliver it, it's like, okay, well, now there's so much competition. Yeah, there is demand, but at a slightly lower price point. So it's kind of meeting some of that reality. A lot of developers have delivered assets at terminal values that are much less than what they had originally forecasted and performed those assets. But we're also dealing, so again, it's a supply story, supply is declining, but also getting to the macro environment, one, it's uncertainty. I mean, whether it's geopolitics, whether it's inflation, whether it's just regular politics, people are uncertain. They are not sure what the next shoe will drop next week. Then we've got AI uncertainty, which again, there's a lot of things to be excited about, AI and technology and tools and all these things. But it's got a lot of people really, really, really concerned for a variety. It's like a basket of reasons. And the biggest thing is change. We are think about the change between, again, good, bad, indifferent, doesn't matter. All the changes from the Trump administration have taken place. It's a different form of governing, whether you love it or you hate it. But it's different, and people don't like change. We're changing the way that we think, that we interact with technology, and we're changing the way that we interact as people through technology and AI. That scares a lot of people. People see their jobs changing. What I do, my livelihood may not even be an option anymore. And that's not just blue collar workers. That's attorneys. That's analysts. That's everybody. Right. What is my value? Everyone is questioning what their true skill set is, and is it replaceable? If it's the thing that they've been spending their whole entire life working towards, is it irrelevant going forward? Right. Do you have to reskill yourself? Every business owner is trying to determine, how should this business look this year, next year? If we don't know what all the solutions are. How many employees am I going to have? Am I going to have employees? What are they going to be doing? Or what am I going to be doing with agents? So this uncertainty, it's not surprising, combined with the fact that we've built more apartments than we have built in the last 45 years, that people might be a little hesitant to go out there and buy that next new apartment. It might make sense why people are maybe moving in with each other, kind of roommating up a little bit. You don't want to it's hard to make big long-term decisions, even though apartment lease is 12 months. A big financial decision, you don't want to make that hastily. So that's why we're seeing more renewals, people staying in place, even if they could probably find a better deal at a nicer apartment somewhere else, which those deals are out there right now. No one wants to deal with moving, and you're like, look, I'm trying to decide if I'm gonna have a job next year. Right. I don't want to look for another apartment. I don't want to move. Yeah. So I don't know. That's my take, and I'm like, it makes sense, and it's what we've experienced. We talked about, again, this is why you watch the Gray Report. We've talked about slowing rents, an increasing vacancy all throughout second half of last year. Yep. Just that's why we do this. Go watch all. Don't go watch all our episodes, or do, but we saw it happening in real time, and it's not surprising. Now it's just showing up in the data, and it's confirming what we all experienced. And when I look at our portfolio, where we were kind of closer to the 93-94% kind of portfolio occupancy, now we have so many assets that are stuck at like 90, 91, or 89. And they can't get over that hump. We used to very rarely have multiple properties that were in the 80s. Now we've got a lot that are, again, 89, 91. We're come on, we need more traffic. Again, we do the property management ourselves, we do marketing ourselves, so we're constantly trying to determine what can we do differently to sign a few more leases.
We've also talked about where where a lot of the growth is in renewals and just resident
Yeah.
retention and having them renew their lease. And so, as you mentioned, just not having the absorption of the new units, people are, potentially more inclined to stay put in this moment of uncertainty. And so we've been not leveraging that, but I think we've been taking that opportunity that we see in front of us to maintain our residents, one, for the health of our investment and our assets, but also it's where the greatest growth is currently in our operations, where
Yeah.
the concessions at the new deliveries are matriculating their way kind of across the market, and they're impacting not just A class but also B class assets,
Yeah.
and even sometimes down to the C class assets. So just any kind of lease trade out on a new lease, it's coming in at probably under where we would like it to be across our entire
Yeah.
portfolio.
And I think this is a good thing. Yeah, let me tell you why. Because in the past, call it 10 years, operators have been able to get by not caring about these communities they invest in.
Mm-hmm.
And you can view them as just investments, and that's fine, and they are. But they're also communities where people call home. And I believe that if we treat them as communities where people live, it can turn into a better investment outcome. You're not really sacrificing anything. But it was easy to ignore that because you were allowing cap rate compression to create a lot of value for you.
Mm-hmm.
Rates were going down, and that just shot values up. You could do a half-assed job on the rehab, be successful on a few and sell the story to the next guy. And that's what a lot of the industry has been doing.
Right.
And it put the resident and the resident experience, it put little value on that. You don't have there were some that were like, that's not right. That's not the way we want to operate things. But today you really don't have an option. And so this is why it's a good thing is you have to focus on operations. You have to actually run your property the way it should be. You actually have to deliver value to residents, because if you don't, they're going to move across the street because the property across the street is probably newer, it's got more amenities,
Yeah.
and they're like, well, if you don't care about me, I don't care if they care about me either, but at least I'm going to get a better deal and it's a better place and there's
Right.
more amenities. If you can build that sense of community, if you can deliver value to residents, not just add value by changing out a countertop or adding paint, like that does add value, but it only goes so far as someone appreciates the value. And so by being true operators, delivering value to residents, that's the market that we're going to be in for the foreseeable future. And I think that's healthy for an industry that I think has gotten away from that a little
Right.
bit. It's going to be more longer term approach. Like, what is the best move for this property over the next, again, 5, 10, 15 years, rather than what do I do to maximize the value on the short term to achieve a high IRR over a 2-year period.
Mm-hmm. The competitive environment with the new supply. One, for residents to have optionality where they live beforehand in supply-constrained markets. As an operator, you could otherwise be asleep at the wheel, and with housing being essential, people need a place to live. They're going to come and live here, one, because it is potentially one of very few options. But now, with supply growing, residents have not unlimited selection of where they want to live, but they're definitely going to be more prone
Yeah.
to move to a place where they feel like they're better taken care of, they're receiving a better value for their money, and a place that is also providing them, the activities of daily living, the amenities, a pool, a weight room, valley trash service, the small things that are also taking care of the physical, asset, the property, and what is their home and their community.
Yeah.
So it makes a lot of sense.
I think from beyond, and like, to be clear, in this business, definitely to make money. Like, this is a for-profit enterprise,
Right.
full stop. I think that we have a huge opportunity to be able to make a lot of money, but also to have a large positive impact on thousands of people's lives. There are thousands of people that live in gray residential, gray capital owned communities, probably close to 10,000. We can make decisions that may not impact profitability at all, and in fact may increase investment profitability by doing right by some of those individuals. We've got everyone's got, mental health challenges. I mean, again, sometimes it can be an excuse. The reality, there's a lot of people depressed, ADD, ADHD. There's new names, new terms every single day. Seems like everybody's got some sort of something, which is, it is what it is. But if we can provide an environment of where people are just a little bit happier, again, it sounds like, I don't know, aspirational, or butterflies and rainbows.
Yeah.
But
we started including resident events in our quarterly updates, quarterly reports, just to show our investors, the community, that their dollars are fostering, and the asset they're invested in is not just an investment, but it's a living arrangement. It's a community. It's a home to young professionals, older adults, retirees, young families.
I think it's the hidden value add. It's the hardest to achieve, but if you can do it successfully, it leads to higher retention rates, more perceived value, and the acceptance of higher rental rates.
Right. Yeah, it gives you a little bit more room.
Yeah,
to justify.
It's like, I'm happy here. If you can create an environment, and I don't say this as in like we're successful at this all the time.
Right. Sure. Sure.
It's aspirational, and we do achieve it. When we do, it's awesome, and sometimes we fail. But when we can achieve this state of where people are happier living in our community than they think they'll be living somewhere else, that's a lot of value to, take the human value out of it. Again, that person is going to be willing to pay $100 to stay in that community for their mental well-being. I mean, just look at what people are spending on that type of stuff. That's a lot, whether it's yoga, whether it's meditation, whether it's pills.
Yeah.
If we can be a component of that, and you're going to stay longer, and that might be worth another $100, and then maybe we've improved somebody's life. That's great as a secondary effect. Maybe it should be first, but again, our responsibility is obviously to our investors to make everybody money. Just how do we do it and create always looking for win-win opportunities.
Right. Yeah. A lasting positive impression.
Yeah. Instead of extracting everything possible.
Yeah. Speaking of positive impressions, we've got
oh my
a new Fed chair nominee, Kevin Warsh.
Mr. Warsh.
Came out in the news the last 5-6 days. The markets seemed like maybe they were pricing in this nominee and some of his past tendencies, and his hawkish versus dovish approach to monetary policy. He's been a part of the Federal Reserve before. General impression on the new nominee, Kevin Warsh.
Well, I'm really curious because in one sense, it's the Federal Reserve it plays an outsized role in everyone's life that no one realizes. By printing money through adjusting interest rates or quantitative easing, purchasing of whether it's Treasury bonds or mortgage-backed securities, the Federal Reserve can influence the price of money and also the rate of inflation. That's kind of what they do. Right now, they're trying to bring inflation back down, but also the impact of money printing is essentially devaluing the dollars that everyone has. So it's the invisible tax, and so you've been saving money and you've got $1,000 saved up into your account, but the Federal Reserve goes and prints more money. They lower interest rates, and that $1,000 is worth less and less each day. That's why, what you can buy with an ounce of gold is pretty similar to what you could have buy an ounce of gold with going back a couple hundred thousands of years.
Yeah.
A dollar is it's not the same. What you could buy a dollar with 100 years, 75 years ago versus what you can today. So having some sort of restraint on the Federal Reserve and not having them continue to expand their mandate, and someone who sees the Federal Reserve through a little bit slightly more traditional or limited lens, which I believe Kevin Warsh does, I think is positive for the long-term trajectory of the United States of America. And what I mean by that is, just some examples. Back in the Great Financial Crisis, GFC, back in 2008, Kevin Warsh was a Fed governor, and he very much had a stance that we should not step in to lower rates further, and that maybe there were points where we should increase interest rates, and was really pushing for more fiscal responsibility and holding the line, and he was worried about future inflation. Now, retrospectively, you could say, like, well, what were you worried about? There was no inflation between the GFC era and the pandemic. We were trying to create inflation. We really weren't that successful. I think a lot of that was because of technology in retrospect that I think Kevin Warsh agrees with. We'll get to that point in a second. But it's hard to argue, but the argument would be that the economy would be in a better place if we actually let the market cycle flush itself out and fully cycle. And what happens is that when the market cycle goes around the corner, gets to the point of crashing, or to a major correction, to a crash, where all of the bad investment decisions are wiped out and allows the economy to reset, the Federal Reserve and Treasury, through fiscal policy, steps in before that and doesn't let that full crash happen. They come in, they prop up the banks, they prop up companies. That's where the too big to fail came in. It's like, you guys can't fail. We need to come in. We need to inject cash. That's what TARP was. We're going to take $1 trillion and put it out to all the banks. And in that case, it really went to the big institutions that created the problem in the first place. So, Kevin Warsh, is, and again, I'm paraphrasing and hopefully not misstating his position, and let's just say that I'm speaking about it in broad terms.
Sure.
But he's like, basically, like, maybe we don't need to step in and save the economy every single time. Sure, the Fed can be the lender of last resort, but we're not actually at last resort. We're just feeling some pain, and we shouldn't step in just yet. And so the concern is, and one of the big criticisms for Kevin Warsh is, will he not step in with all of the tools that the Federal Reserve has now been accustomed to using in a period of financial crisis? So COVID came in, we looked at the playbook, and we're like, well, man, we didn't really have that much inflation last time. Let's just print. And you could argue that they saved the economy, maybe. Again, it's hard to prove a negative. What would have happened? Again, it would have been more painful, but is the end result healthier for the long run, as opposed to compounding problems because you never actually fix the true disease? You're just solving for symptoms.
Right.
And so now in the context of today, so Kevin Warsh called him more hawkish, but that flies in the face of what the Trump administration has been saying and criticizing Jerome Powell for basically saying, look, you need to lower rates. We've got inflation is under control. You need to lower interest rates. You need to lower interest rates because they know that would stimulate the economy. There's an argument that mortgages would get cheaper. Maybe they would. The Federal Reserve obviously impacts the Fed funds rate and the discount rate, not the longer term Treasury yields, although they could if they really felt like they wanted to through yield curve control or buying up Treasury bonds. But the idea of Kevin Warsh, he believes that potentially, Trump administration wants rates to be lower.
Yes.
But Warsh is saying, hey, no, I'm more hawkish, but there's a caveat. And the reason why the Trump administration is interested in Kevin Warsh, I think, is two-pronged. One, short term, he is interested in lowering rates because he believes that AI is hyper deflationary and that inflation may not be a concern in the near term because there's going to be so much deflation and probably job losses because of AI hyper productivity that, like, look, no, the Fed funds rate can come down. But long term, let's not expand quantitative easing. Let's actually reduce the Fed's balance sheet. And the result of that may be higher for longer, long-term rates, maybe more stickier just where they are, not necessarily increasing.
Right.
But the 10-year Treasury is at 4.16 today, 4.2 kind of, it's been in that range. Instead of coming down to 3.5, where a lot of folks are maybe thinking it could eventually get down to, maybe it stays up around that 4 handle. I don't think the economy crashes in that environment. And then the question is, though, is the U.S., our balance sheet, and are we more fiscally responsible over the long run, and does that put us in a more advantageous financial position because we haven't been able to print as much money? And so people are baking that in and saying, okay, well, maybe so where this impacts multifamily and why markets crashed. We're not crashed, but they certainly were jolted. Is that all of a sudden you're saying, look, we're looking at a longer term 10-year Treasury. The 10-year Treasury is the most important, rate financial instrument in the world. It's what mortgages are indexed off of, whether it's a single family home. It's what our multifamily loans are indexed off of. It's what corporate debt is. It's so much are indexed off the 10-year Treasury, and you're adding a spread. The risk, what the lender is charging. And so if the 10-year Treasury and the longer term rates stay elevated, that means it's going to be more expensive to buy capital, to buy businesses, to buy real estate. That means that the prices of those assets aren't going to be able to grow as quickly because you're not going to be able to use as much leverage. There is a connection, not a direct correlation, but a connection between the 10-year Treasury and cap rates. So over time, we're looking at an environment of where cap rates will have some resistance to compress. They could compress further, but they're not going to be able to compress as much or as quickly if those long-term bond yields are somewhat elevated. And so, again, it's related to real estate, but it's related to how you're discounting the future pricing of all assets. And so the entire world had to re-examine, all right, well, the long-term trajectory of these asset prices may be slightly lower if we're using less leverage. Again, so as an investor, you don't like seeing, lower terminal values potentially.
Right.
But as someone who's thinking about, the U.S. economy, maybe it is a healthier move.
So you're saying there's no, not really coincidental. It's actually more of a cause and effect of when this announcement with Kevin Warsh kind of came out in the mainstream media. You saw some pullback in equity markets, crypto markets. Obviously real assets are not value, but I'm sure REITs also maybe saw some devaluation occurring.
Well, I think crypto is the best example. I mean, crypto is basically, they're part of the original idea of, Bitcoin was like, look, this financial system is broken, it's messed up, it's hyperinflationary, it's completely fiat. If we're going to have fiat, if we're going to make something up and ascribe value, let's do it, but let's limit supply. So Bitcoin, there's limited supply.
Right.
It's all, so again, it's not just a big bet because there's other utility, you could argue, digital gold, store of value, speculative, whatever you want to describe Bitcoin as. But it's all a bet on maybe we might be moving away from the U.S.-led financial system, that global system, and looking at an alternative. Because maybe the U.S. dollar, how long is going to be around? 1 year, almost certain. 5 years, pretty sure. 10, 15, who knows, depending on your politics. But now all of a sudden, when people are looking at it and saying, oh, well, the dollar actually might be strengthening a little bit. Again, when 2 weeks ago we thought the opposite.
Yeah.
Okay, well, maybe the U.S. is going to be as bad. The dollar might not be destroyed. There's less of a reason to go big on Bitcoin. Combined with there's this other idea of being able to use quantum computers to be able to hack Bitcoin, which I think is kind of overblown. That could be another reason why there's some correction. But
pulling out of there.
I've been
buying slowly on the way down.
Buying slowly,
small units.
Because we started talking when I think Bitcoin was around 80.
Yeah, I think
85, and we were starting to get curious.
So this is maybe we're getting off track, but we love to do that. I got into Bitcoin that's probably 2021, 2020-ish, kind of when the world shut down, everybody was on their phones, and what were those things called? NFTs were coming out. People were trading these digital images, and you could make them and sell them. And I kind of got interested in that and was watching it for a while. I think my average cost basis of Bitcoin right now is $55,000.
Okay.
So I'm doing pretty good.
Yeah.
But as I was buying on the way down, when it got to 100,000, that was my cue of all right, you can start to buying small tranches of Bitcoin. So I started buying 100,000, 90, 88, 82, and then with this one,
60.
This happened, and I was like, okay, pause. You got to pause because.
So now let me ask you this. So okay, now this test your conviction, and I found myself in this exact same position related to Bitcoin, Ethereum. This was around one of not the first big crash, but I think it was 2017, 2018 when the big crash happened. You have two choices. You either say, fuck, I was wrong, or go all in, double down.
Yeah.
What are you doing? Are you?
I'm in for a small enough dollar amount where the double down is not that hard.
Yeah.
It would be
It's like, do you believe in it or not? I mean, that's what you have to
Right.
ask yourself. Is it it's not binary, but if you view it through that lens
Right.
of like it's gonna be,
You're
it'll be
walking
at $1
out-
million at some point, or it's gonna go to zero.
you're walking out of the casino. You made $100 for the night. It's not really going to do you any good, but $200 could potentially buy you dinner. So you go out and you put it on red.
It's a 2x equity multiple.
It's 2x equity multiple, and you get free dinner when you're in Vegas. You put the $100 on red and just see what happens. I think it's kind of wild. And if you look at Bitcoin, there's so many people out there that they don't own any Bitcoin, and then there's the very few people that are these whales with massive wallets, and that I think his name's Michael Saylor. He's just like gung ho on it, and you just. In the world of crypto, you get all these pump and dump schemes, but Bitcoin doesn't seem to be that. But with people with those larger positions that go on, CNBC, or they, go on live stream to, pump Bitcoin and its value, and you should hold on to it and buy more when it's down. I get a little skeptical of those people. Like, you have such a large exposure to Bitcoin, and you're telling me to buy more. Like, it seems a little selfish.
Oh yeah, yeah.
Actually, seems a lot of selfish. So I have. I've just kind of gone on a gut feeling, which is probably not ideal. But I do. I still have maintained a risk on for the Bitcoin.
Well, now that we're later in the episode, not many people are listening.
Yeah.
Get into a little bit more of the conspiracy angle.
Yeah.
It's global reset asset prices. I mean, you wouldn't take a lot of fundamental understanding of the impact of an announcement like Kevin Warsh to know that, hey, again, maybe if long-term rates are going to be higher for longer, a little more fiscal discipline, might see a decline in gold, silver, had seen huge run-ups, as well as Bitcoin.
And the wealthy just buy it all up.
That's what, if you knew it was going to happen, again, if you had the confidence to be like, look, nothing's really changed. We just made an announcement about some guy.
Right.
And you believe that silver is going to continue to move. Bitcoin is you go and you want a better cost basis.
Yeah.
You don't like the 120. I want to be able to get a 2x equity multiple, buying at 60, getting back to 120.
Right. Yep.
What thoughts?
I read about this the other day. It seems like it's got probably a little bit more merit than I want it to. But I'm also.
So do you jump on that bandwagon though?
I'm
and
also in
be like,
position-
I want to be in that group that's like buying the assets on a discount. Like, okay, maybe I didn't, cause the crash or whatever. I didn't.
Exactly. I'm in the position to be like, hey, you can make the most of this opportunity. And if that opportunity doesn't come to fruition, it never materializes. I don't think my life is going to be upside down. Because there's other real assets that we can invest into. But I do think it's quite an interesting take, because I did read this, and I'm not a conspiracy guy, but it did pop up, and it walked through this global reset of really just kind of like asset values across, whether it's equities or real assets or whatever. All of these large holders of Bitcoins, or everybody got super liquid, and hey, we're going to make this announcement. We're going to plug these few players in. Things are going to have this drawback, and then we are going to deploy all of this liquidity into these assets, and we're going to get it at a great basis, and then we're going to watch it run up as the transition of value goes from the dollar to Bitcoin.
Yeah.
I'm having a hard time, personally having a hard time, of when I cash out my Bitcoin, they're going to give me dollar bills back.
So you want dollar bills?
Well, so that's my thing.
And isn't that the bigger question?
Do you dump your dollar bills into Bitcoin? But why, if I want to cash out a position in Bitcoin, do I get dollars back if it's not debased, but it's supposed to be kind of independent of the U.S. dollar?
But you don't have to.
Well, so
you're looking at it through a USD.
Yes, because that's the only way that my wallet platform will do it.
Yeah, you can set your settings to. I mean, so you could.
Can I trade it out for yen or?
Yeah, 100%.
Oh, really?
Yeah,
I just thought it was so interesting that
you can trade You can trade Bitcoin for Ethereum. You can trade coin to coin.
I knew you could do that, and you can put in stable coins or whatever. But stable coins are dollars.
They're pegged to dollars.
Yeah. I just have a hard time trying to understand
and we most likely will all be using stable coins, won't be called stable coins in the future.
Yeah.
And that's where and this is where I do think that there is some long-term legs for Bitcoin for, again, a variety of reasons beyond the macro conspiratorial, is just that the financial system has incorporated a lot of blockchain technology, and a lot of things are going on chain. Things that we've been talking about for the last 10 years. A lot of that is happening. DeFi, decentralized finance, was really hot a couple of years ago. It hasn't gone away. It's just being incorporated.
Yeah.
Because we've always talked about the underlying blockchain technology. Separating that from the individual tokens themselves and the utility that they all provide, but the ability to have on assets that are on chain, essentially, that are verifiable, that are open, with whatever controls you want. Is there is a lot of utility and value just in that itself. So,
right. What do you say to people that have zero Bitcoin and they maybe they have the means to go out and buy $5,000 of Bitcoin? It just feels like my grandkids one day, if I can keep track of my wallet and all of its codes, could potentially be sitting on a big fat goose egg, but they could also be brought into this world with an incredible leg up because I kind of foolishly chased this down.
Oh no, I don't think it's a bad move. I think I see it as kind of similar but different to gold. I wouldn't look at anyone and say you need to go buy gold or you need to go buy Bitcoin. If you have the means, is it a good idea, like buying insurance? I see it as a form of insurance first, and as a speculative asset class probably second. Some people probably inverse those two.
Yeah.
And I think that's okay. If it's a speculative asset class, I think if it's like your savings, that's not what I would recommend. The way you said it, you're going to casino. I think that's closer to the way you have to look at it. Maybe not the exact same, depending on, again, if you're like, look, this is for my grandkids.
Yeah.
And then it really doesn't matter. Same thing with gold. You buy gold, you're not going to go sell your gold. I mean, people do, but you buy the gold hoping that you'll never need the gold.
I think the get rich quick Bitcoin or maybe crypto is kind of a thing of the past. I don't think you're going to see the large increases in value like maybe they did from $100 to $1,000. Maybe we do, but there's other cryptocurrencies that you can see some overnight millionaires being made by guys that are placing some crazy bets on something that otherwise maybe they shouldn't. But
other than my original crypto investments back in, I think, 2012, my crypto returns have been very similar to my silver returns since like 2021-ish, when I re-upped on crypto around that time period in 2021.
Yeah.
Probably maybe, I think my cost basis at that point was closer to like 13K or something, but I probably bought some around closer to 20.
Huh.
And then silver, like my cost basis was like under $20, like kind of
that's awesome.
17 or so. But but all of that was like never really intended to like sell. But the silver, which is like was been stuck, around $20 or below $20 since like the 80s.
Mm-hmm.
That was I invested in silver not because I thought it was going to turn into a meme stock, because I thought that like it probably isn't going to get any lower, and it was like a safe place. It was a store of value, and maybe because I was looking at gold and silver ratio, maybe there's an opportunity for silver to move up. I literally didn't look at it for like a year and a half. I mean, I did look. I wasn't paying attention for a year and a half, and all of a sudden I look at it and I'm up.
Equity multiple.
I've got I've got a 3x on silver.
It's incredible. I guess I say that because it's hard not to type into ChatGPT what will the price of Bitcoin be in 2035, and it'll spit out some $150,000 mark, and it's hard not to get excited about a long-term hold outlook for cryptocurrency, whatever one you're into, just because I think the use cases are getting more widespread. I was reading the other day about, I think it's called the Clarity Act. Could be wrong, but it's potentially in the House or this. Yeah, it's being reviewed by our United States government. But if it does pass, it will essentially take Bitcoin, which is a commodity, and potentially turn it into a security, and offer the opportunity for large wealth investment platforms to allocate into the asset class. So RIAs could be dumping trillions of dollars into Bitcoin, if that passes, and it just as more and more people gain access to it, the scarcity aspect is there. If the demand goes up, you can just see the rise in value. So I am a long-term holder for certain, and it's tough because when you see the value of Bitcoin skyrocket, was at like 120,000, let's just say in October this past year, who knows when it actually was. I was sitting there like, okay, we could sell this. We could definitely sell it and, rebuy it when it goes down. But time in the market, and if you miss, you're just kicking yourself.
Yeah,
So long term is the way to go.
The last time I sold Bitcoin when Bitcoin hit $800.
Yeah. Yeah. What's incredible, you were in before it was at $800,
Yeah, the first one I was like 100.
That's awesome. 8X.
But I sold most of my Bitcoins when I hit 1,000.
Yeah. I remember watching a video. There's a guy that paid for pizza with Bitcoin.
Yeah.
He paid like 3 Bitcoin for this pizza.
No. He paid like 100 Bitcoin for
Really?
it, or like 1,000 Bitcoin for the pizza.
Unbelievable.
Yeah. So I want to just wrap things back up to multifamily, because I think there's, and it relates to all the changes going on in the world, and uncertainty and speculation. And it brings me back to multifamily. Because even though, maybe we're looking at discount rates and cap rates that may not compress as much over time, but I don't know what the price of Bitcoin is going to be in 3, 4, or 5 years.
Yeah.
I don't know the price of silver. I don't know where the S&P 500. I don't know where AI is going to take us. I do know, though, assuming that humans will be here, and if not, this conversation doesn't matter.
It does not.
But assuming that humans are still here, which I believe we will be, because I'm an optimist, they will need a place to live.
Mm-hmm.
And some of those people, probably the majority of people, are going to be renting. And apartments make a lot of sense. So we know they're going to be in demand, and we know that they're going to be needed from society.
Mm-hmm.
Where rent levels are, I mean, we have a pretty good insight because we know kind of what supply looks like. And, we know that the demand is there. So we know that this asset class is always going to be in need. It's going to be around and producing a return in 5 years.
Yeah.
So in a world where there's uncertainty, and I say that for 2 reasons. One, it still makes a lot of sense to invest in multifamily. But 2, because, again, there can just be some clarity that it's literally going to be there. But then that fact creates demand on the capital side. And that is what, is going to keep cap rates, where they are or lower. Because in times of uncertainty, there's a flight to a foundation of clarity, of certainty. And again, office, we don't know what office is going to look like. But again, people always need a place to live. Mm-hmm. And one of those places are going to be apartments.
And I think just to layer some icing on what you just said is the long-term perspective on multifamily asset class and housing in general is very bullish.
Yeah.
Just because of the essential nature of housing, specifically in the multifamily asset class, the trend of renters, maybe for longer or by choice, really makes the asset class stand out for a long-term hold versus other asset classes that would otherwise be, kind of quick pivots or, flip style real estate. There is so much uncertainty, so much change occurring just in general. But I was listening to this great perspective of rapid change, of how fast things are moving. If you wanted to get on a wagon and go mine gold in California, it was months long journey. Today you can get there in 4 hours. If you want to write a research report, 20 years ago, you had to go to the library, sit down, go through the books. Now you have AI, you can do the research report in a matter of minutes. All of this change is happening so fast, and it feels almost overwhelming to try and keep up. And we're seeing that in our industry, whether it's property technology, investment software, CRM software, how to connect with our investors. In the world of so much uncertainty and fast pivot and change, it's nice to be investing in an asset class that will fundamentally stay the same in regards to shelter, roof over your head, place to sleep, and a place to eat. There's not a whole lot of change, and I don't think human beings will see a whole lot of change in what they're maybe seeking in regards to shelter. Yeah. Obviously, there's different amenities that we can add to our properties, but our business model really has and probably will stay very, very similar amidst all of the change. We'll have new tools to implement different efficiencies in our operations, but the fundamental structure of a multifamily building has a long-term potential.
I mean, and for all those reasons, that's why I see it as, you're investing in like a Again, that's why it's a real asset. It's
Yeah,
a real it's a
steadfast
physical
real
asset
asset.
that has just an incredible amount of utility to society. And again, we know that's going to be in demand. And it's like when I think about gold, the reason why people invest in gold is because people have been buying and holding onto gold for 5,000 years. There's been a human demand for gold for 5,000 years. Well, shelter, it's even longer than that. It's the dawn of civilization. And so we know it's going to be relevant. You know, what the price is in 5 years, you know, you could say, well, yeah, it's going to be there. You know, will people have the ability to pay rents in 5 years? It's a good question. I think so, because again, there's demand. You know, will prices change? Will prices reset? Is there volatility? All that's possible. I think if you were approaching it the right way through first principles, you buy right, you finance right, it's cash flowing, I think you're going to find a lot of success. And what I always could come back to when you try to break down a multifamily deal, you always find yourself describing a scenario. Not all deals, but you often describe a scenario where if the multifamily is at zero, everything's at zero, and there's really no true safe haven. And again, maybe you got gold still, but in the world where like the multifamily is at zero, everything's at zero, and there's no hiding it. If no one has the ability to pay for rent, we got a lot of other problems to deal with.
Yeah, the world is burning.
Yeah, and I think the government's probably just going to print checks for everybody for a while before that happens.
Yeah.
Whether that could be horrible, but that would happen first. We saw the stimmies.
Yeah, we did. It's a good asset class to be in.
We may see stimmies this year.
Maybe.
We'll see. Or tariff dividends,
tariff
payments or something.
Yeah.
It won't be bad. It's a great episode. If you want more of this, make sure you're following us on all the social medias. I mean, we tell you to subscribe to the Great Capital YouTube channel, which you should have already done, which you can still do right now. But once you've clicked the button, Instagram, LinkedIn, we're really active on LinkedIn. I post things, Griffin posts things, Great Capital posts things, Facebook. There's a variety of ways to interact with us. One way, if you're an accredited investor, you can like schedule a call with us and talk to us about what you're trying to do, whether it's talking about the market, what you're seeing, or helping you plan out your acquisition strategy, investment strategy, related to multifamily for 2026 and beyond. Again, none of it's financial advice. You know, we're only giving real estate advice. Always consult with your advisors. And again, we only accept investments from accredited investors, and that's because the damn SEC, not because we don't want to do business with everybody. That's just the government telling us how you can spend your money and who we can do business with. But thank you for watching this episode. It's been great. It's always a good time. Thank you, Will, for being patient with us. Slow start in a long episode. Once again, long-winded, but all for good reasons. See you on the next episode of The Great Report.
Yeah, we will.